Hello, everyone. My name is Brad, and welcome back to the Dividend Reaper YouTube channel. Today, I want to jump into what I talked about in my last video that I might be doing. I want to start doing basically a review for those of you out there who don't really enjoy reading and nonetheless don't really enjoy reading a book that is over 600 pages of investment speak. And I'll be talking about the book, The Intelligent Investor. I'll be trying to break it down in the simplest terms that I can, which sometimes might be a little bit difficult considering this book can get pretty in depth, but I'll try and open it up in the best way that I can in terms of just kind of summarizing the points made within and really trying to hit home what I was able to get out of this because I really feel that this is probably the best investment book out there in my personal opinion. I know there's a lot of people out there that have different opinions on this, but this really was the kind of the capital selling point for me out of all the investment books that I've ever read. If you don't know what book I'm talking about, this, of course, is The Intelligent Investor by Benjamin Graham. And if you, by chance, don't know who Benjamin Graham is, he is seen kind of as the father of value investing, basically the mentor of Warren Buffett. But basically, he has written this book to show kind of his way of value investing and seem to have gotten a lot out of it in the past. So let's jump right into it. Chapter one is basically titled Investment versus Speculation, which is a really good opening for this book because I feel like this is the cardinal point that a lot of investors really screw the pooch on because it's so hard to get away from it. Um, I'll kind of jump into it a little bit and then we'll have a little bit more of a discussion about it. But basically, investment versus speculation is an investment operation is one in which, upon through thorough analysis, promises safety of principal and an adequate return. Operations not meeting those requirements are speculative. Regardless, of course, there are inherent risks in common stock investments which cannot be separated from the opportunities of profit that are offered. Both the risk and the potential profit must be weighed against each other. It's basically the difference between this is an investment that has been soundly researched and can be estimated as good as you can estimate a stock and a company with the knowledge provided versus the simple speculation of, I think. That's kind of the best thing that I can really just narrow this topic down into. It's trying to make sure that you are not a speculator sitting there, I think, versus these are the statistics, these are the trends that have been happening. Statistically, this is what it is more likely than not to do. And of course, looking into the investment side of it, which is make an investment, not a trade. Um, Continued through the book, he does go on to argue that speculation can be unintelligent or intelligent, um, but obviously it can most often be unintelligent. Most often through speculating when one thinks they are in fact investing. So again, going back to that earlier point where you think you're investing, but really if you're listening to yourself argue your points, if you're really talking a lot about I think, you're probably more towards you're probably speculating and you think that you're investing. That's one thing to think about in yourself when you are trying to argue with yourself as to why you might be trying to invest in a certain company. Additionally, speculating seriously but lacking the proper knowledge and skill for it. Kind of in that same boat. And finally, risking more money in speculation than you can afford to lose. That being said, a non professional who is operating on margin is effectively speculating, and so is anyone who is buying a hot stock or operating in a like minded fashion. Um, Basically, again, trying to dumb this down as much as I can. A lot of investors are actually more so speculating on what's going to happen rather than trusting the actual metrics themselves. And a lot of times can get themselves into a lot of trouble when they're risking their whole pots on these. You see this with day traders a lot where they put a ton of money down and follow these trades with, almost their entire portfolios, just to try to kind of risk it all to gain it all. And a lot of that is speculation. And obviously, to a certain point, it can be an investment if you've really done your homework on a stock. But at the same time, when you're investing a lot of your portfolio or a lot more than you can afford to lose, you're really starting to weigh the scales in favor of speculation because you're putting so much of your money, for lack of a better way of explaining it, in one basket. Nevertheless, he does argue in the book that you can still do it, but just don't use a large quantity of your money to do these kinds of trades, and don't think that you're doing anything less than speculating when you are doing something like this. So ultimately, chapter one is, I would say, one of the most short chapters in the book. Not a whole lot to share other than just his take on speculating versus investing. And I don't want to spend too much more time on it because I feel like I've already kind of beat a dead horse with this topic. But next time I will be trying to go into chapter two. I might do another video in between, depending on how this all shakes out, because the budget will be finalized here in the next day or two as well. But chapter two, again, if you have not read this book, or even if you have and you're just looking to get another person's take on the book, chapter two is The Investor and Inflation. Stay tuned next time as I go through that. And if you liked this video, don't forget to like, comment, subscribe, do what you need to do. But thanks so much, and I will catch you next time. Have a good week, everybody.